everybody. Welcome to another webinar here at Route Consultant. For those of you who are here for the first time, my name is Josh Gregory. I am the Vice President of Education here at Route Consultant. If you've never worked with us before, our team ran hundreds of routes across the country in both pickup and delivery and line haul in the FedEx space. And today we're really here to help new buyers that are looking to get into the space for the first time, and also to help current contractors as we're trying to navigate all the things that are happening both in the FedEx industry and in the logistics industry as a whole, find efficiencies, add profitability, and really be successful every day. And for everyone else who's here every week or who watches us on YouTube every week, welcome back. And whether this is your first one or you're here every week, we always want this to be a place where you can come, learn a little bit, find out about what's happening in the industry, and then any questions you have, we always want to be here to answer it. But before I get too much farther, I do have a quick disclaimer to read, as I do every week. Route Consultant is not endorsed by and is not recommended by Federal Express Corporation, FedEx Ground, or Amazon. Route Consultant is not sponsored by, is not approved by, is not associated with, and has no connection whatsoever with Federal Express Corporation, FedEx Ground, or Amazon. Now, all that to say, we are here to make sure that you all learn. And like I said, we will have questions and time for questions at the end. So if you do have them, my only request is that you put them in the Q&A button at the bottom of the window. If you put it in the chat, I might miss it. So if you're trying to have those questions answered, make sure you click that Q&A button at the bottom and type it in. You can type it in at any point while we're talking, but we will have dedicated Q&A time at the end. And it can be questions about everything that we talk about today or anything about the industry as a whole. We'll be here to answer them. Now, just a quick note for everyone who's here on the line haul side. The new contract is rolling out soon. And if you're a current contractor, you've probably been following this closely. There have been a few changes and then some changes that FedEx walked back and removed. So in a couple of weeks, when everything is finalized on that contract, we'll do a webinar where we'll give you an update on what to expect for the rest of the year and in peak season and what that looks like. But we're just going to wait a couple of weeks until that actually finalizes what we're looking at, and we'll talk about it. But for today, as we come towards the end of the year here, we want to give some updates on how we're seeing the line haul market right now and really talk through how to understand the value of a line haul listing in general in this current environment. And so it's not just going to be me talking today. So to add to some perspective to that conversation, I've brought on our executive sales director, Butch Butler. So Butch, if you want to go ahead and jump on and say hello, and then we'll get started.
Hi, everyone. Thanks, Josh.
Butch, it's a pleasure to have you here. So I guess, I told him your title, but just give a quick background on yourself for anybody who might not have met you before.
Okay, thank you. My background is in investment banking. I started working with Route Consultant coming up on 6 years ago, and have been fortunate enough to work across the country helping broker these transactions for the last 5 years in different capacities, and love what I do. Get to help a lot of people into the space and have a firsthand feel for how pricing and market valuations are adjusting on a daily and yearly basis, and it's been fun. So
yeah, perfect. And I always like getting to have these conversations with you. I think you've got a great perspective on the industry, and like you said, you've been here for a while, so seen more of these deals than just about anybody in the country.
yeah, lucky enough to have done a couple hundred plus, so yeah. It's been fun.
Yeah, perfect. So I think let's just start with, when we're talking about these deals, we always talk about what a business is worth, and we often talk about it in terms of a multiple. So what does it mean when we say a business is a 4 multiple or a 5 multiple? What does that mean when we're talking about it? And then we can add some color to it.
Sure. I mean, in the most basic form, investors will pay a certain multiple for a cash flow that a business generates, right? And so a standard multiple in this space is anywhere between a 3.5 and a 4.5. And they really do depend on the quality of the business you're buying, and what goes into that is objective and subjective, frankly. And so no two people are going to come up with the same valuation for the same business. And I think that's probably by design. Beauty is in the eye of the beholder when you're pricing these.
Yeah. And there's a lot more that we'll talk about there. And one of the things that people always ask is, that NOI that we talk about, what's included and what's not in that.
Okay. And so this is an important distinction, really, and particularly as it relates to different leasing options, especially on the line haul side with fleet strategy. So our typical NOI on one of our prospectuses is really what I'll call an operating cash flow or an EBITDA, earnings before interest, taxes, depreciation, and amortization. Importantly, we also, when we get to an NOI number, we are not factoring in owner's compensation. We're removing that from the equation. And we're also removing things from the equation like capital expenditures. And so for us, an NOI number represents an EBITDA or an operating cash flow. From an accounting perspective, everything above the line, so to speak.
Yeah. And it's really important for everybody who's on here. I want you to hear how we're pricing these, what we base operating income on. We think that's the best way. We think that we're including the right things and excluding the right things. Not all brokers will do this the same way. And sometimes you might see a seller bring a listing to market without a broker. So it's really important to kind of conceptualize and understand all the terms we're talking about, how we get to these numbers, how we use them, so that if you're not working with us, if you're talking to anybody outside of us, that you have the right questions to ask to really clarify when they're showing you an NOI or whatever they decide to call it, what it's really coming from, and make sure that they're not including things or excluding things that really should be a part of that conversation. And we see it all the time. Another thing too, Butch, when we're showing these, is there any kind of future, projection baked in, like, or any type of growth baked in? Like, how do we think about it there?
We are very conservative when we put together our prospectus. We base it on historical information, the most relevant and current information that we can get our hands on. How business operated a year ago should not play a large role if there's a material difference in how it's operating today when you're thinking about valuing that business. So for us, we use backward-looking data, and we never include anything in there as it relates to growth or peak. And on the line haul side, growth is pretty predictable. I mean, you mentioned it at start. Every line haul contractor gets a rate increase from FedEx starting September 1st. So we know it's coming. We also know peak is coming, but we don't include either of those things in our calculation when we're trying to come up with a baseline for our EBITDA number, our NOI number. And so, yeah, using historical backward-looking data, no growth, some of the factors that we really know are going to happen, we also exclude those just so as to try to be conservative when we're coming up with a cash flow number. And that really is the most important thing as you start to think about multiples is you can put a multiple of anything on whatever, but you really need to make sure you've got your cash flow number right to start with before you think about applying an appropriate multiple to it. And the multiple is going to be based on a lot of qualitative factors and some quantitative factors with the business, but understanding what that real cash flow number is, apples to apples, is a critical place to start. And even within some of our listings, we, like everyone, we use accounting. And so if you have a lease model for your fleet on the line haul side, there are two options. You can have what we call an operating lease, where you're going to trade off margin for that operating lease, but it's sort of a no capital expenditures model because you put a deposit down with the lessor, you turn your trucks back in 3 years, and you get new equipment. That's very different from an accounting perspective than if you're using leasing. And I use air quotes here for those not on camera because lots of the leases that we work with are really just what I'll call methods to finance the acquisition and purchase of trucks. And so that would be a traditional capital expenditure. So not even all leases are created equal to get to what I'll call a consistent NOI number. So understanding your cash flow is critical, and whether it's one of our listings or any other one you look at.
Yeah, and I think another important point to hone in on here, when we're showing these expenses, is there any work that we do to get to what we think are appropriate numbers, or is it just straight from the seller?
No, absolutely. That we look at the data from the business. So with things like payroll, we should be able to, and anybody should be able to tie the drivers that were employed to the runs that were being serviced, and that's on the pickup and delivery and or the line haul side. You should be able to tie back your payroll to the revenue that was generated from that payroll. So we'll use historical payroll, but we will always put in most of the time a little bit of cushion for things like employee turnover, for things like vacations, and the fact that some of these businesses experience a little bit heavier payroll over time than we can capture in a 12 to 16 week snapshot. So on payroll, it should be very verifiable, but at the same time, you can be a little conservative putting in a cushion. Revenue should be completely historical. That's what we look at there. And again, no growth, no peak, no line haul rate increases, no new contracts on the pickup and delivery side. Fuel is one that you should also be able to estimate very carefully. On the line haul side, you can see if they're purchasing fuel at a hub or a terminal exactly what they're spending on fuel, but always double check and figure out how many miles they're running, what the cost of fuel in that geography where they're fueling up should look like, whether it's pickup and delivery or line haul, and try to get your arms around the trunk of the tree on just a, hey, look, this makes sense for the quality of miles per gallon I'm going to get out of this fleet, the number of miles they're putting on the trucks a week, and the cost of fuel in the geography they're buying it. So you can rely on historical data, but at the same time, it's pretty easy to do an estimated calculation to see if you're in the ballpark.
Yeah.
As you work your way down the income statement, things like insurance, very verifiable, technology, extremely verifiable. The one area that we are reluctant to just trust someone is on repair and maintenance, because they can show us as many receipts and sellers can tell you that this is what they spend. But having run these fleets and having a lot of experience with people who do operate them, we again can try to get our arms around the trunk of the tree and say, listen, this is what we think it should take to operate a fleet like this. And we have a lot of historical data and relationships to validate that. So we can usually sniff out something that might be amiss in repair and maintenance as well. But thankfully, these business models are really transparent. And you can use largely historical data that is relevant in the time frame and come up with what is a very good operating model.
All right, 100%. And I will call out too, you mentioned, a lot of times there's some things like payroll that we're using more recent data. I will see some people, and it's not often malicious, but I will see some valuations that are out there that aren't from us that are basically taking a tax return and applying maybe some kind of assumed growth metric on top of that, and just kind of saying, hey, that's what the business looked like this year, and so this is what you can expect for next year. What kind of pitfalls can you run into by not looking at what the business is doing today?
Well, you really need to capture the most current information, or you will run into pitfalls. These businesses in the FedEx world change relatively quickly over time. Some people will acquire territories or additional runs. There may be freight and volume characteristics that are different in the spring than you'll find in the fall. And so if you just look back at a historical payroll and then try to apply a growth rate to it, you're really missing the exercise, which the exercise is to marry the current revenue run rate with the resources that are necessary to generate that revenue. And if you're actually, and you should be able to look at those two in tandem to make sure that you have enough resources in your model to account for what you're going to need to generate the revenue. And so those two, the more current and accurate data you can get, you should be able to do a very solid analysis with 12 to 16 weeks of recent data to just get your arms around what the business looks like it's performing from a efficiency and a profitability level at its current run rate.
Yeah, and that's really important. You need to know what resources are being used to generate the revenue that exists today. It's great to look at historical data. We always do, and you should have it as a lens into how those expenses have trended over time. But when you're thinking about what you're paying today, what the multiple is today, and what resources you'll need today, a lot of it does depend on what the business is using, because you can get really misleading info, both positive and negatively misleading, if you're looking at the business from 2 years ago. If you find out, it may have looked that, like the trucks repair and maintenance was great and the payroll looks great, but today they may have ended up in a situation where payroll's wildly bloated and all of their trucks are old now. On the flip side, it may look like the fleet was horrible 2 years ago and repair and maintenance was explosive and payroll was high. And it may be 2 years is plenty of time to correct those issues. And maybe today they've replaced that fleet, or it's all leased and we've got, a handled payroll, but you can't know that unless you are also looking at what the business looks like today. And what we'll always say in these conversations is, we're going to show you what it is today. We're going to help you understand the price and the multiple for it. And we're always here to help you understand also what are the changes that you can potentially make to improve it in the future, so that you know it, so that you kind of see those gaps and ways to improve it, but also understand the way it is today and why you're paying the price you are today.
And we've had pretty significant wage inflation and other areas of inflation over the last 12 to 18 months. So you really want to capture the most recent data to eliminate missing some of these factors.
Yeah, 100%. So I think a really important conversation here that as you're getting into the line haul space, I probably get this question on the valuation side every week, which is, there are different types of runs. There's dedicated runs, there's unassigned runs, there's spot runs. How do we think about those differently from a multiple perspective? Because as we've talked about, when we're talking about NOI, that is the ultimate basis for the multiple. But do any of these runs change the multiple that we assign to it? Or do we add more favor to certain types of runs? And how are we thinking about that today?
Yes, I think the run portfolio is one of a handful of what we'll call qualitative variables that will affect your multiple. But there is no doubt that a run portfolio that consists of more dedicated, consistent work is going to carry a higher multiple relative to a business that may have less dedicated work. Now, if you look at businesses that operate on the dedicated board, they're not all created equal too. So you can look at a portfolio of 6 solos in 2 different markets and think, well, these 2 should carry a similar multiple, but that's not even true, because just because they're both dedicated portfolios of runs, some could average 2,200 miles a week and some could average 3,200 miles a week. And there's a massive difference in what someone will pay for a dedicated run depending upon the mileage of it. So yes, the first bucket of valuation differential, it can be dedicated versus unassigned, but make no mistake that there are variables within a dedicated portfolio that matter just as much. And so when you move your way down from the dedicated work to the unassigned work, that really, there are extremely healthy businesses that operate on the unassigned board and have a significant amount of value. A lot of that is going to depend on the volume that they consistently get on a weekly basis, how good the operator is at staffing that business, because I don't care if the work is dedicated or unassigned. If it's not staffed, it's not creating cash flow. How consistent the volume is. And then other factors would be things like, where is the business located? How difficult is it to hire in that market from a geography perspective, whether you're operating in a hub or a terminal. So all of these factors are going to play into it, whether you own your trucks, whether you lease your trucks. So yes, whether a run is dedicated or unassigned or even spot is going to play a factor in the valuation, but the run portfolio is only one factor to consider when you're thinking about putting a multiple on an entire business. It's an important one, but it really is just one.
Yeah. And I think that's a good note to just underline, in that all of these runs have value. They all are important. If you're trying to get into the space, regardless, one of the most difficult things about line haul is getting in for the first time. So if you're a new investor, any run is your best first step for a lot of people, because that first step, if you wait for the perfect business, and line haul in particular, you may never find it. This is a market where there are very few kind of pushes or incentives on sellers or contractors to sell. There's no huge growth push from FedEx. A lot of people can stay the same size. There's not necessarily the same dynamics that can cause it to be more difficult to run. There's a lot of contractors that have reached a size that they're very comfortable with and never want to sell. They never change. And so there's just fewer of these that ever hit the market. So that's really important context as you're thinking about line haul. Any of these could be the right first step for you. The important thing, like Butch said, is understanding what it comes with the business and understanding, the different variables that sometimes are qualitative in terms of just understanding. There's a lot of context in these terminals around the mileage, the destinations, the dynamics of the hub versus an independent terminal that can really affect the difference between 2 listings that on the face of it may look very similar.
Exactly.
There's another point that you brought up that I think is, when we were talking earlier, that is, I think, really interesting, where you kind of called out, you may see a business that has a $1 million top line, 200,000 NOI. You may see a different business that has a $2 million top line, 200,000 NOI. So the NOI is the same. In theory, we could assign the same multiple to each, and they're the same business. But You look at that one with that higher top line. How do you think about a business like that differently? And what are some of those additional qualitative things that people might need to be thinking about as they're evaluating these?
For lack of a better couple of words, size matters. It does in this space. And if the business is bigger, it allows you to run it differently. You have the flexibility and the revenue to put some infrastructure in place, be it a BC or maybe it's a second BC. Maybe it's a mechanic, but putting resources from a large business into infrastructure allows you as an AO to have a different role in that business. So, just because, as Josh said, you could have two different businesses that are both generating 200,000. One of them, the AO, could have very little infrastructure and spends 30 hours a week in that business. The other could have a fair amount of infrastructure and spend 10 hours a week in that business. So if you're thinking about buying one of these businesses, which one do you think it deserves the higher multiple? The one you got to spend 30 hours a week to get your 200 grand, or the one that you spend 10? So, it does matter. Having additional revenue and additional resources allows you flexibility on the line haul side in particular but really P&D too, to have a week where you miss a couple of runs because you're not staffed. If you have a business that has 3 runs, and you go a week or two without operating one of those runs, you're giving up 20-30% of your weekly revenue, at least, not operating that. Now, if you have a portfolio of just call it unassigned runs, and you're operating 12 unassigned runs, and you have a week where your capacity is a little bit less because either you have staffing issues or the freight's not there. If you're operating a $2 million business and you see a 20 or 30% decline, you still have a fair amount of revenue to play with. But if you're operating a much smaller business and you see for one reason or another your revenue take a dip, whether it's mechanical issues, staffing issues, freight issues, it is just hard to keep the resources and the infrastructure in place, be it your BC, be it your drivers, because if the freight's not there, drivers are still going to expect to have some compensation that week if you want them to continue to work for you. Well, that's a lot easier if you're operating a bigger business with 10 to 12 runs as opposed to a small business with 3 to 5.
Yeah.
So size matters. Roles and responsibilities, Josh, is something that everybody who on this call, if you're thinking about getting into this space, should really strongly understand what are the roles and responsibilities of the humans in the business to generate the NOI. And how does that marry up with what you want as an AO in a business that you acquire, and make sure the roles and responsibilities fit, because looking at cash flow is great, but figuring out how you're going to get to that cash flow and still live your life in a way that makes you happy is what we really need to get to.
Yeah. And, I think when people are evaluating these businesses, they do think about the time that they want to invest. And that's a part of the thought process when they're evaluating these. But I don't always think that the right value is ascribed to that, in terms of the difference between 30 and 5 hours in a week is a huge amount of value, in terms of, maybe it's just quality of life, or maybe you have another job, or maybe you're trying to think about spending 15 hours a week on recruiting and growth, and that's your focus, and you don't have time to have a lot of operational investment. So that additional time in a week is certainly worth some amount of money. And I think it's sometimes missed how valuable that can be and how much that should affect a multiple. But I think it's always important to kind of re-highlight and help people conceptualize that.
And it's also, it makes a difference to how important you are to FedEx too. The size of your business, the number of resources you bring to your customer, that matters.
It's both leverage in getting new opportunities and, a little bit more weight at the table. If there is something that goes wrong, they're much less likely to be able to just, come at you. They know that they need you the larger that you are. So you've just kind of got a little more leeway to figure things out. You've just got a larger business, and it does give you a seat at the table, and it lets you have a little more rope when you need it.
And when it comes time to assign new spot work or find someone to handle the growth, FedEx is naturally going to go to those people who they think can handle it most efficiently.
I think just as a last thing here that we're touching on, we've touched on it a few times, but just can you give a little bit more on how you think about the leasing when we're talking full service leases versus owning a fleet, in terms of how we think about valuing a business? Is, one that we favor over the other? How do we think about that?
think that is a real personal choice. And I think it depends on the size of your business. The larger you get, the easier it may be to have a dedicated vendor relationship where you have more leverage over your repair and maintenance process if you're bigger. But there is a real trade-off to be made by every AO out there in terms of, first, do I want to own my trucks, or do I want to have what I'll call an operating lease? Meaning that you're going to have repair and maintenance wrapped into that lease. You're going to pay more for it, but in theory, you're going to have an easier business to operate. I personally, if I were doing this, would own my trucks. And that's simply because I don't want to write a check to the government every year without that depreciation. So I would opt most of the time in most opportunities to own trucks. But I can make an argument in some businesses, especially team-oriented businesses, where you're going to be sending your drivers across the country. You need to keep your fleet extremely fresh. And in that instance, I could hear the argument that you're turning in your trucks every 3 or 4 years anyway. So there's no reason to own them. They're going to be under maintenance and repair from a warranty perspective. So just trade a little margin for it, make it easier. And I could see that argument. But the real difference from my perspective is in one instance, you're going to have CapEx upfront, and then you're going to trade operating cash flow to operate your business at a little bit of a lower margin. But then you're going to turn your trucks in 3 or 4 years, and you're going to get new trucks. That's sort of a no CapEx model. You put a deposit on hold with the lessor, you pay more for the trucks, but at the end of the day, you turn them in and your deposit stays there and covers it. That's very different than going to a leasing company, putting down 10 grand, making truck payments for 3 years, and then coming out of pocket 65 grand or 70 grand for the truck at the end of year 3 or 4. To me, that's just a financing method. And so with that to me feels like traditional capital expenditures. You can call it a lease if you want, but it really to me is traditional CapEx. Those businesses can also come with a full service from a repair and maintenance perspective. So you really, when you're looking at a business that has leases, you need to evaluate the cost of the leases relative to the benefits. What happens at the end of the lease? How soon is that lease ending? And if I buy a business that has leases that I'm taking on as part of it, does that mean that I'm going to come out of pocket in 1.5 years to buy that truck, or am I going to turn my trucks in and get new ones without coming out of pocket for it? In either way, we capture the value of that in terms of a multiple perspective, but there's no doubt that your multiple, even if it holds its multiple at 4, for instance, you're trading operating margin. So the value of that business when you're really leasing, it's more expensive, and your cash flow is going to be affected negatively, because when we measure cash flow, we're not measuring capital expenditures, we're measuring operating cash flow. So if your business is operating with an operating lease, you're going to suffer that in the operating margin.
Perfect. I think this just in general, there's a lot to think about when it comes to Linehaul, when it comes to the multiples and the right price to pay for it. I think the first note for everybody is finding the right Linehaul business is not always going to be where you're picking from 100 options. There's not always that many choices. So you're trying to find the best one for you, where you understand the business, you understand, the pros and cons of it, and it fits what you're looking for. But when you're kind of thinking through a due diligence process here, it's always important to understand the numbers, understand the NOI, how it got to it, what it justifies for the business. And then beyond that, there are really important qualitative measures that you have to consider to really understand what a business is worth. And I'd say that's one of the hardest things to properly ascribe when you're trying to figure this out for the first time. And it's what we do every day. We do hundreds of these every month and year. And what we're always trying to do is help you to understand really what you're walking into, and help you understand the right price to pay, a fair price to pay for this business, to get a good business and get in for the first time. And whether that's with us and you're looking at one of our listings or outside at any listing, we're happy to have those conversations and make sure that as you're getting into the space, you're paying a good price. We always want to make sure that, but we want to make sure you understand why you're paying a good price. That's going to be the best thing for you when you're trying to think about moving forward and being successful in your second and third acquisition in Linehaul. You need to understand what good is and what good isn't. And that's really what we're trying to do when we have these conversations.
Right. And what good factors and bad factors led to that NOI? because just because the numbers are X and Y, figure out how we got to X and Y is really critical for you making the right decision on what business fits right. And it's the littlest things like operating in a hub versus operating in a terminal. Most people, they think about that. Oh, it's not that big of a difference. Maybe it's better to operate in a hub because you can get fuel there. That is a very positive factor, but you may find it much more difficult to hire in a hub than you would in a small terminal. So all of these things really go into factoring a valuation for a business, and none of them are really that much more important than others. The numbers matter, but understanding why the numbers look the way they do are just as critical.
And that conversation is why when, some people will ask us, how much is a run worth? Just on its own with nothing attached to it. And it is essentially impossible to answer because you can look at the hard numbers, but there's so much context to any business that you have to know when you come in. And really every business is different. There are unifying characteristics, but that analysis can't just be at the number level to really know what a business is worth and not all dedicated runs are the same. I see numbers thrown around of a dedicated run in general is always worth X, and an unassigned in general is always worth Y. And that's just not the case. There's so many.
Cringe when I hear that, Josh.
I know. It's almost impossible. Yeah. So really, I think that's what we wanted to cover today, to give you guys a really good sense of what goes into this and all of the other factors you really need to think about when you're looking at a line haul business. So we'll open it up for Q&A in just a second. I have a couple of things that I want to go over that are coming up and new listings that have come out. So if anyone has any questions, put it in the Q&A and we'll get to it in just a second.
Josh, I'm real quick. I want to add one more thing that I didn't get to in terms of really driving valuation. And a lot of that is whether or not it's eligible for SBA financing. If you find a business line haul or pickup and delivery that is eligible for SBA financing, that's going to drive a higher multiple towards that business, even if all the other factors are less than desirable. So just know there are a lot of levers that people pull when they think valuation, and what's important to one person may not be the most important variable to another. And so, we don't get to decide exactly what a business is worth. We just help facilitate the buyer seller coming to a price that makes sense for both of them.
Yeah. And the financing conversation is, that there's a whole suite of variables that, the lease versus own conversation is different with financing. Looking at, does the bank have assets as collateral or not? There's the multiples that a bank may push for, like there's all different parts of that, but financing will affect the equation. And in particular, both the multiple that it goes at and the speed with which that deal closes if it is financeable.
Thank you. Sorry about that.
No, you're definitely right to bring that up. Perfect. So, like I said, we will open it up for questions in just a second. A couple of quick highlights on the inventory side. We do have a new P&D listing that came out this week. It is 8 P&D routes out of Central Texas, and it's at $399,000. This one has 8 employees, a manager, and it's really low mileage operation. So it's a pretty low price point entry into the FedEx space, and it's got a manager in place with a low mileage operation. So if you're looking for Texas, those come and go quickly. So we've got a new one on there for you. And then the other listing or series of listings to highlight, if you didn't hear last week, if you haven't seen, we have a large partnership with Flowers Bakery at the national level. We've had about 70 listings go live over the last week across the country. And more than just the listings that we've had go live, we have a bunch more inventory that either we haven't built yet or we're waiting on. If you have interest at any place in the country, at really any size, reach out to us and we'll make sure to kind of matchmake you with some opportunities, because really we have the capability right now of piecing together listings at really any size, at really any place in the country. So if that is something you're interested in, if you've been trying to get into that side of things, reach out to our team. Happy to talk you through really any and every opportunity there. A couple of upcoming events to highlight. We do, if you're still a new investor trying to get into the space, we do have our new investor workshops that we host throughout the year. That's really a a time in person for us to meet you, talk to you, give you a ton of additional information, really help you make that final decision on if this is the right space for you or not. Our next one is actually on September 27th in our offices here in Nashville, and you can sign up for those on our site if you're interested. Our next happy hour, where we travel and allow you to meet with us and bring our team out so that everybody who's in the area can come together, contractors can network, anyone who's interested in meeting contractors in the area. And our next one is in Denver on September 10th. And if you're interested, it's free to sign up. We've got the link on our website for how to register and where it will be. So that is it for events and upcoming things that have happened this week. I'm not seeing any questions, so if you've got any, you better start typing fast while I give the countdown of going once. Oh, there's one. Butch's contact info. They asked if they can get that, Butch.
Happily so. You can put it in the chat.
Okay, yeah.
Whoever can. I can say it right now, whatever you want. So
yeah, it's probably easier for me to type it in. Are you still Butch? Just
it's Butch at Route Consultant. Yep, that's it.
Yeah, Butch and I are some of the old guard who've managed to hold on to the one name emails here.
Yeah, there's only a handful of us still.
Yeah, there really is. Yeah, it's great. Yeah, and so it's in the chat and in the Q&A. Other than that, I'm not seeing any questions. I think I've given enough time. Butch, thank you so much for being on here, providing your expertise. I think it's one of the most important things we can do is kind of allow you to pull out from the front lines and give that bird's eye view of how this space is trending.
Thank you. I appreciate the opportunity to talk with everyone, and come see us in Denver. I'll be there. So hopefully we see you.
Perfect. All right. Thanks, Butch.
Thanks
everybody for being on. We'll see you all next week.